Hey guys, JC Parets here of allstarcharts.com, and welcome back to the show. Big shout out StockCharts TV for inviting me on. I'm JC Parets. I'm the founder of All Star Charts. If you haven't seen me on Twitter, YouTube, Instagram, StockTwits, look me up on the blog. We're always putting out good stuff, and we have a killer team. Willie Delwich just joined us after 20 years at R.W. Baird. Welcome, Willie. Steve Straz have been on board for a long time. Louis out in New Zealand. Grant Hockridge over in Moscow, great team, and Greg in Baltimore, and we just get to talk about markets all the time. Literally, this is what we do all day with clients, with some of the smartest PMs in the world, traders at hedge funds. So while we do a lot of work internally, the conversations that we're having with traders and PMs and family offices and things of that really provide a tremendous amount of information that we use also. And generate ideas too. I mean, we're not looking at everything. I mean, it seems that way sometimes, but like we miss things. And the constant communication that we have with our colleagues and our friends and our clients, it really helps us, makes it really hard for us to miss things. That's how I look at it. So what is the point of this show? So what do we normally do? We normally kind of, I said, all right, guys, we should probably have a section that's particularly for education purposes, maybe talk about a specific topic or strategy or philosophy about technical analysis in the market. Then we can look at current markets, right? That's why we're here, to talk about what the market is actually doing. And then we finish up with some questions. So if you have any questions, make sure to send an email to askjc@allstarcharts.com, and we'll go ahead and answer these questions here. And we have a few set up from questions that we've gotten over the past week. All right, so what is today's topic? I think today's topic has to be market breadth, because there's a lot of misconceptions out there as far as what it is, what it isn't. People are like, oh, market breadth doesn't work anymore. Market just goes up no matter what. It ignores market breadth. Or sentiment doesn't work anymore because the market is ignoring sentiment. Like, no. Sentiment and breadth are working just fine, just because the way you look at sentiment and breadth and things of that nature are incorrect, or you're not good at doing that. Maybe you're not good at it yet. Maybe you don't have enough experience, or maybe you're just confused on how the mathematics work or historically what the market has done. That might be the case, but it's not that sentiment and breadth no longer works, right? Quite the opposite. We've seen it, these tools be incredibly helpful, particularly, always, but, especially in recent times over the last, let's call it 15 months or so. Breadth was deteriorating severely before the market peaked in February last year. I mean, it wasn't even close. The market peaked the prior year in December. So it was already, most stocks had already been rolling over for months before the S&P and NASDAQ peaked. So breadth works just fine. Thank you very much. And then not to mention the oversold conditions. But let's talk about breadth now. So over the weekend, we had our monthly conference call last night, and over the weekend we're putting together charts, we're putting together the deck, and Stras is going through the deck, and he's like, what the hell is slide 29 or whatever slide this was? And he's like, there aren't any new lows. Why are you even showing that? And my point was, that's why I'm showing it, because there aren't any new lows. He's like, oh, yeah, good call. Right? This chart is so obnoxious. Right? Like, for the stock market to fall, you need stocks making new lows. Like, you need stocks in downtrends to pull the market lower, right? That's just like, this is market breadth, folks, right? It's a market of stocks, not just a stock market. We're looking at the Russell 3000 to really get a broad measure. People are like, well, JC, why are you comparing the Russell 3000 to the S&P 500? I mean, you can put any index up there. They're all kind of like the same. Dow Industrials, maybe the small caps are kind of like parabolic, so I shouldn't say that. But the S&P 500, the Dow Industrials, the NASDAQ, to the point is they're making higher lows, higher highs. They're going to fall. You're going to see an expansion in new 21-day lows. So right here, these 21-day lows. Why 21 days, JC? Because the 21 days basically is about a month. 63 days, basically about a quarter. And 126 days is basically about half a year, depending on the way a calendar works. But these numbers are good enough. So the point is, the new 52-week low list, don't even look at it. Right? There's no point in even looking at the new 52-week low list, because so many stocks are so far from making new 52-week lows that there's no information there. What we want to see is go down the scale. In order to get to 52-week lows, you need to be making 21-day lows, right? Baby steps. And then, you know, before we're making 52-week lows, we need to make new quarterly lows, right? New 63-day lows, new 126-day lows, right? New biannual lows. They're not, none of those are perking up. That was really my point with this chart. This chart was like, what are you showing that for? Right? Because there's nothing going on, right? When you start seeing the perks, when you start seeing spikes and new lows, that's a heads up. Now we start looking for bearish momentum divergences. Now we're looking for breadth divergences. Now we're looking for shorts. When we get that spike, we start fading rallies, not buying dips like in uptrends, but fading rallies instead. Those are the types of characteristics that we should see. So the point of my obnoxious chart is that there's nothing going on. Like nothing. Zero. Okay. JC, but things are too good. Stocks like, oh my God, they only go up and so many stocks are making new highs and blah, blah, blah. Yes, that is true. And while some might look at it like, well, breadth is just too good, the market can't go up anymore. Some people were looking at it like that. I mean, they've been looking at it like that for 8 months, which is hilarious. But too good, right? Too strong. Markets that are too strong, markets that are too good, markets that just have an overwhelming, relentless bid is perfectly normal for the beginning of market cycles, the beginning of new bull markets, not the end of them. This is just one of a million examples I can give you. Maybe not a million, but it's definitely double digits because like internally we joke, like Straza's like, and another one, right? Which by the way was Biggie Smalls, not DJ Khaled for you young bucks that are like, oh, JC, that's Khaled. No, that was Notorious B.I.G. and another one. So we internally, it's like an inside joke because we keep seeing these breadth thrusts in the NASDAQ and small caps and mid caps and large caps in this particular case. Globally, we're seeing breadth thrusts. And these breadth thrusts historically happen at the beginning of bull markets, not at the end of them. So here's just a bunch of examples. These are the percentage of stocks that are hitting overbought conditions, which are bullish characteristics. People are like, oh, JC, how can I buy this stock? It's overbought. It's like, well, how can an overwhelming amount of buyers possibly be a bad thing, right? Is how I look at that. So anyway, look at these breadth thrusts, just an overwhelming amount of relentless buying, which, as you can see in this chart, where those green circles are drawn, look here in 2003 coming out of those lows, look in 2009 coming off those lows, look in 2010 and 11 coming off those lows, again in 13 when we broke out to new all-time highs. I mean, just, right? These are things we see in environments that we want to be buying stocks, that investors are being rewarded for owning stocks, not shorting them. So folks, that's my take on market breadth. It's a weight of the evidence. Are more stocks going up? Are more stocks going down? I think we can argue more stocks are going up. We're going to get into a couple of different, while I'm on the subject, let me just actually show you. So what are we looking at here? This is since September the 2nd, right? People are looking for a stock market correction. That's what they're telling me. JC, we need a correction. Stock market is too high. It needs to correct. There's too much complacency. You're too complacent, JC. That's what they tell me. JC, too complacent, you bull-tard. That's what they call me. I get called all sorts of things. Like, fine, all right. So there's stocks that are doing well, obviously. But let's talk about what the biggest stocks in the world are doing. Let's talk about Google, Apple, Microsoft, Amazon, Facebook, Alibaba. Going into today, which is the 20th of January, these are 8 to 10 trillion dollars in market capitalization, which is a lot. That's down over the past 5 months or so. Down, not up, not parabolic, not complacency, right? None of those things. Down. JC, Alibaba's not even an American stock. That's what they tell me. It's one of the biggest companies in the world. What do you want me to tell you? Trades on the New York Stock Exchange. Stop, right? It's one of the most important stocks in the world, down 20% over the last 5 months. You're looking for a correction? What's that? How about this? These are the biggest companies in the world. NVIDIA, Facebook, Google, Amazon, Apple, Microsoft. Nothing, nada, zero, zilch. Remember, I feel like it wasn't too long ago that they were telling me, oh, JC, it's only 5 stocks that are driving this market. It's only 5 stocks, JC. Remember? It's hilarious. It was a lie then. Obviously, it's a lie now. I mean, I guess they don't say that anymore because none of these stocks are doing anything. They haven't done anything for months. Now it's the small caps, right? Mid caps, biotechs, You know, a lot of these other names, you know, some of the emerging market names, just parabolic, right? Chinese internet. But look at these things. Nothing. These are the biggest companies in the world. So there's two things going on here. Number one, obviously, you know, when people are like, oh, JC, we're waiting for a correction. It's like, okay, well, what the hell do you call this? Number one. Number two, this is information. How these names resolve, these are the bellwethers, folks. Google and Facebook is like half the communications index, right? Apple and Microsoft is like, I don't know, probably almost half the tech index. Like probably pretty close. What is it? Like 40% between the two of them, I think. And then Nvidia, boom, there's your half. You know, Amazon's like a quarter of consumer discretionary. Nothing. By the way, consumer discretionary is making new all-time highs, and Amazon hasn't done anything for 5 months. And it represents 25% of the entire consumer discretionary index. So just to show you how strong discretionary is, that it's able to do what it's doing, continuing to make new all-time highs without the participation in Amazon. Also interesting point. So if these resolve lower, I'd argue that's a big problem for the market. I would argue small caps and mid caps and all these parabolic names will probably follow along and come down. That's my bet. If that were to happen. Now, the bet we're making is that that's not going to happen, that they're going to resolve higher. And these corrections, this stealth correction, if you will, think about how well even the S&P 500 and the NASDAQ have continued to do well, even without the participation of the biggest names. You know, people aren't paying attention to this. I don't know why. Seems quite obvious if you ask me. And then what else? Stocks are making new all-time highs, as they should be. Why on earth should you expect anything else? Why should we expect anything other than new all-time highs in stocks? Is there anything going on in the world that you can point to that says, aha, because that's happening, stocks shouldn't be going up? There's nothing. Nothing. Oh, shit. I just spilled my water. My point is there's nothing that's going on. Treasury bonds are making new lows relative to the S&P 500. New lows. And what should be happening in an environment that's probably taking place? Stocks probably should be doing well. Consumer staples, that's a flight to safety, right? If stocks are under pressure, you're going to see these managers allocating more assets towards the more defensive areas of consumer staples over the stock market, right? Staples tend to outperform when stocks are under pressure. Well, they're making new all-time relative lows. They're not outperforming. They're doing the opposite. They're underperforming. So what should we expect stocks to do in an environment that staples are underperforming? They should be doing well. Guess what? They're doing great, right? Gold, you know, gold can outperform in an environment that stocks are doing well, right? But I would argue if stocks are under pressure, you should probably expect gold to be outperforming. Well, it's not. Again, pushing down near new lows. Aussie yen, same thing, right? Aussie yen making new highs. Aussie, you know, commodities, exporting, China, right? Global growth, that's Aussie. Yen is more unwind, right? You know, carry, you know, defensive, flight to safety on that yen. So that Aussie yen is going to be a nice indicator as well. Well, new lows for yen Aussie, right? New highs for Aussie yen. So these are the most important things happening around the world, all suggesting that investors are probably being rewarded for owning stocks, not for shorting them. And that's exactly what's taking place. So when you have zero data points suggesting that stocks should be selling off, why should we be shorting stocks? I'm not seeing it. So those are the things that we're watching, guys. You know, breakdowns in these big names, spikes in the new low list, you know, a bid in some of these more defensive areas. Those are the things that we're looking for that would suggest that shorting stocks would be more advantageous than buying them like we have been. And by the way, if you want these slides, make sure to email info@allstarcharts.com. Make sure to include the password because I give presentations, you know, in various countries around the world, and you could wind up with some Malaysian palm oil futures presentation. So make sure that you are that you include the password stealth correction. So info@allstarcharts.com info@allstarcharts.com, password stealth correction. All right. And then Peter will go ahead and send it over to you. All right, what else can possibly happen and by the way, the reason I'm getting so macro and so bigger picture is because, I mean, it's quite obvious that we should be looking for stocks to buy, right? I mean, it's been quite obvious for 8 months, right? Nothing has changed. So rather than going through and, you know, looking for sectors and stocks, like you guys know which sectors and stocks to look through, right? look for relative strength, positive momentum. You know that. We'll mention a couple of names here in a minute. But you don't need me to do that. What I think today is point is to really take a step back and identify what's really going on around the world. And is there anything around the world that suggests that selling stocks is a better idea than buying them? Because there hasn't been, right? Unless like you follow the news and you think that's relevant, and if that's the case, then you're probably in the wrong show. But for us, that we actually focus on what's actually taking place, not hypotheticals, not gossip, not he said, she said stuff, Biden this and Trump and Yellen and Powell, and who's got time for that? We're focused on what's actually taking place. And I think a big one that we want to follow here is the US dollar. Because if you notice, when the US dollar peaked in March of 2020, that's when stocks started doing well, right? And before that, stocks had been under pressure for quite some time, really since the beginning of 2018, when risk around the world peaked. That's when the dollar started doing well. And the dollar peaked in March of 2020, stocks started doing well and have been in decline ever since the dollar, right? Straight down for the dollar. And what's been going on? Emerging markets outperforming, base metals doing well, global growth, industrials, materials, just stocks around the globe doing well. Sector rotation down the cap scale, et cetera, all taking place with a weaker dollar, starting when the dollar started to weaken. So a stronger dollar, I would argue, would probably be a tailwind for stocks, number one, or could be seen as a flight to safety because stocks are under pressure, right? Which came first, the chicken or the egg? I really don't care. I would expect that to happen simultaneously, regardless of the reason. Is the dollar going up hurting stocks, or is the dollar going up because stocks are getting hurt, right? I don't really care which one it is, but I would expect that to happen simultaneously. To be clear, that is not happening. There's zero evidence that the dollar's about to rip. Quite the opposite, actually. Everything we're seeing continues to suggest that the dollar should remain under pressure. Strength in base metals, emerging markets outperforming, all of the things that you would think would do poorly in a stronger dollar are doing well. Right? All right. Sticking with the currencies, what about Ethereum? I'm getting asked about that a lot. We did really well with the Bitcoin, obviously, for you guys following along. Ethereum has gotten to our upside objectives now as well, back to those former highs. So now what do? We leave it alone. Leave it alone. What are you going to do? We're below overhead supply, right? Buying Ethereum here is like buying gold in August. How about that, right? Gold in August got back to those former highs from 2011 and then stopped going up when it got there, which is perfectly normal. They teach you this sort of resistance stuff on the first day of technical analysis kindergarten. There shouldn't be a surprise. And gold's been a horrible idea to own ever since, which makes perfect sense. Gold got back to former highs. Last time we were here 10 years ago, gold sold off like a lot. I think silver lost like 80% or something ridiculous last time we were here. So why should we expect anything different, right? So gold's sucked since August. So buying Ethereum here is like buying gold in August, right? We're below overhead supply. Why do we have to be in such a rush? Why do we have to own gold now? Why can't we just wait for gold to break out and then buy it? Like, why do we have to be angry gold bugs all the time? Like, why do we have to do that? We don't. It's been a better idea to buy literally anything else. Right? So Ethereum, it might not take as long as gold because, August, September, October, November, December, January, 5 months. Gold's done zero. It's down, actually, right? Over the last 5 months. I don't know, and quite frankly, I don't think that Ethereum's going to take that long because gold still hasn't broken out. So now we're probably going on 6-7 months at least, right? For gold, who knows? So Ethereum, is it going to take that long? Probably not. These cycles happen faster in the cryptocurrency. When Bitcoin got to its former highs, it took, I think, 3.5 weeks, 3 weeks, something like that. So Ethereum could be similar. In fact, I would argue it's probably going to be closer than sooner than something like gold, if that even ever breaks out. Who knows? It may never. So the point is 14.25. That's the level. Below that, I don't think it's worth the headache. I think you leave it alone. Wait till we're above the former highs. Why be in such a rush, right? Same as, gold. It's because when we were selling gold in August, right? I didn't know how long it was going to take. Maybe it takes a few months. I don't know, a few weeks. Who knows? Maybe a couple of quarters. Maybe it doesn't Maybe it doesn't stop at all. Who knows? And as it turns out, we're going on 5-6 months already. So I don't know how long it's going to take. So, I think there's better things to worry about, personally. It's been a great trade. If you've been in it, congrats, Now, here's something that's taking place that's new. Commodities breaking out above those 2016 lows. This is the CRB index making new highs. New highs. I don't think that's bearish for stocks. I think that continues to be a tailwind for stocks and crude oil, right? Crude oil back above all those former lows, right above 40, right? Think about it. It's not bearish, right? Demand. Base metals doing well. Interest rates going up. Here we're looking at the copper-gold ratio squeezing. See the copper-gold ratio squeezing higher? Notice how it looks exactly like the U.S. 10-year yield, also squeezing higher, right? So this squeeze in copper-gold leads me to believe that we're getting back to 1.4 in the U.S. 10-year yield, right? That's the target there. And taking this one step further, here we're looking at regional banks versus real estate investment trusts, right? So as the market thinks interest rates are going higher, you're going to get that bid in regional banks, particularly on a relative basis. As the market thinks interest rates are going lower, fixed income investors aren't able to get their yield in the bond market. So they're going to go to the stock market to get those higher dividend paying stocks, REITs, UTs, being near the top, staples for that matter also, all making new relative lows. Utilities making new relative lows, REITs making new relative lows, staples making new relative lows. Those are the highest dividend paying areas. Nobody wants them. Nobody wants them because the market is pricing in higher interest rates. So why should we be buying bonds? No, sell them, fade them. Bonds making new relative lows. Clearly the market agrees. Copper-gold ratio making new highs, as we just mentioned. U.S. 10-year yield also making new highs, right? So 1.4, that's where I think that we're going. And here's a close-up of that chart. So these U.S. 10-year yields, right? Getting back up towards 1.4. That's that former support. My bond trader friends get mad at me when I say that Jay-Z is not support in the yields. It's resistance in bonds. It's like, all right. But then I talked to a guy who's got $11 billion in assets, and he's telling me about resistance in yields. And I was like, well, that guy must have done something right, so I'm going to listen to that guy. Point is, it doesn't matter what you call it. We're all adults here. Supporting yields at 1.4, 1.4, 1.4. Break last year, and now I think we're heading back. And by the way, you guys have been following along. That breakdown in yields and that ripper in bonds was part of the reason we're so bearish of equities. Be like, if rates are collapsing and breaking down to new decade lows or all-time lows, how are stocks probably doing in that environment? Our bet was stocks are probably under pressure. So let's get the hell out of them. So we did. And so now we're seeing the opposite, right? So as yields are going up, what's probably happening in an environment that yields are going up, right? Stocks are probably doing well, right? Commodities are probably doing well. They're countering some kind of inflationary forces. So the bond market's pricing in higher inflation. Commodity prices are pricing in higher inflation. I like stocks in that environment. Let's take a look at some stocks. So this one comes directly from our minor leaguers report, right? So we're looking at $1 to $2 billion market cap companies. And, we started the 2 to 100 club because we're looking for the next $100 billion companies. But this starts at $2 billion when they graduate from small cap. So this particular scan, this is the minor leaguers, so we're scouting the farm system, if you will, looking for the stocks that will then graduate to mid cap and enter that 2 to 100 club. In this particular case, we opened it up to any industry group. For the 2 to 100 club, there's specific industry groups that can scale to 100 billion. For the minor leaguers, we don't need it to go to 100 billion. We need it to go to 3 billion, right? So we don't need, it doesn't have to be cloud computing or software, or, direct to consumer stuff. It doesn't have to be that. Solar, right? We don't need it. It could be a regional bank, right? God forbid we buy a regional bank, right? Now, granted, you're probably going to find a lot of software and biotechnology and semis and things like that here too, medical devices that you'll find in the 2 to 100 club, of course. But we're less discriminatory. Well, we're not discriminatory at all, actually, in the minor leaguers. So these are names, we sort them by new highs because they're not going to graduate to mid-cap status and get above 2 billion by making a lot of new lows, right? That's just math. So they got to be making new highs in order to get on the list, or at least getting or close to new highs. So let's take a look, see what's going on. So here we're looking at Crystal Biotech. This comes directly from the minor leaguers, and I like this base, right? Beautiful base, about a year-long base. I think we break out. If the stock is above 67, I like it long with a target of 88. So Crystal Biotech, KRYS, we only like it long if it's above 67 with a target of, if it's above 67 with a target of 88. And then Lovesac, we broke the rules here. Sorry, Straza calls me. He's like, hey, GC, I really like this name. I think it's like a 600 million. It's not at a billion yet. So we broke the rules here. So check your liquidity, check your, make sure that you can own something that is this small. This is kind of like the smallest name we'd ever bring up ever. We usually bring up other kinds of names like these, right? So we broke the rules here, but we break the rules for a reason. It's a nice base, and the risk reward is great. If it's above 46, I like it long with a target of 72.5. So if it's below 46, leave it alone. I only like it if it's above that. And look at the relative strength breaking out as well. By the way, if you want these slides, I'm going to take some questions now. If you want these slides, make sure to email info@allstarcharts.com. Password stealth correction. All right, JC, how do stocks do during a presidential inauguration? Listen, I think that we're, overthinking the whole inauguration thing, I think is probably a mistake. But we are in towards the end here of the sweet spot, the best 3-month period of the year, which is November, December, January. Everybody always likes to say, sell in May and go away. But you have to remember to buy in November or buy in October and get yourself sober or whatever it is that, you say. But that's for a reason. November through January historically is the best 3-month period of the year, number one. Number two, the best 7-day period of the year historically comes between right around Christmas and the first couple of days of the year. We call it the Santa Claus rally, and Santa Claus came, so no big deal. Not a signal. It was just market went up when it was supposed to. So that was that. So in terms of seasonality, the month of January is generally a good indicator. They call it the January barometer. As January goes, so goes the rest of the year. So that's how I look at seasonality. Fun fact I got from Ryan Dietrich, my good buddy over at LPL Financial, actually mentioned the fact that on the day of a presidential inauguration, the stock market has never been up. The Dow's never been up ever, going back to 1897. Hasn't been up in 120-something years. Isn't that crazy? So if the stock market is up today, Wednesday the 20th, Joe Biden will be the first one since 1897. Shout out McKinley. So that's how I think about that. So I try not to think about it, is really the answer. Too much anyway. If the dollar rallies, is that good for gold? Is that good for gold? I mean, the dollar, as we just mentioned, the dollar just got slaughtered. And gold's down since August, making new lows relative to the rest of commodities, new lows relative to the S&P 500. This isn't a weak dollar environment. If gold can't rally, look at silver pushing down against new relative lows too. If precious metals can't rally in a weak dollar environment, man. So I don't know is the answer, because I would have expected gold to do pretty well if the dollar was going to get slaughtered. Nope. So that's how bad. Nobody wants these rocks. JC, how can stocks keep going up? They need to correct at some point. Oh my God. Guys, emerging markets have done nothing for 13 years. Europe has done nothing for 20 years. Japan making 30-year highs, still down from 1989. Hong Kong down for a decade. Look at the pigs. Portugal, Italy, Greece, Spain, all down. Israel flat for a decade, just now breaking out. I'll leave you. Listen, I think we've gotten the corrections. I think we're just now breaking out. Look at Taiwan, South Korea, Israel. Look at the percentage of these countries that have technology. I think that's the big story. I also think we've seen corrections. We continue to see corrections. I guess that's the time. Time's up. How did I do? I was pretty good, right? 29 minutes. All right, guys. Thanks very much. I appreciate you being here. Again, if you want the slides, email info@allstarcharts.com. Password stealth correction. Say what's up on Twitter @allstarcharts.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.